$600 billion in market value just vanished from artificial intelligence stocks in a single trading week. Nvidia, Microsoft, Google, the companies everyone said were untouchable, the ones propping up the entire market, they all collapsed simultaneously. And Wall Street is calling it a healthy correction, a natural pullback, just the market taking a breath before the next leg up. But what if this isn't a correction at all? What if this is the first crack in the largest financial bubble in human history? A bubble so massive, so interconnected, so fundamentally unstable, that when it fully breaks, it won't just crash the stock market, it'll take down the credit system, the banking sector, and the currency itself. Stay with me, because what I'm about to reveal in the next 60 seconds will completely change how you understand what's really happening to the global financial system right now. The headlines are blaming profit-taking. They're saying valuations got stretched, and investors are rebalancing portfolios. They're pointing to some economic data, some Fed comments, some technical levels being broken, all perfectly reasonable explanations for why the most hyped sector in decades suddenly lost $600 billion in days. But none of that explains the timing. None of it explains why insiders at these companies have been selling stock at record levels for months. None of it explains why the selling accelerated precisely when retail investors were being told artificial intelligence was the safest bet in the market. And nobody's talking about what's actually breaking underneath the surface, because this isn't about AI stocks being overvalued. This is about the entire financial system being built on a foundation of AI hype that was never real to begin with. And when that foundation cracks, everything built on top of it comes down. Let me show you exactly what's happening. The AI bubble didn't start with ChatGPT. It started in 2022 when the Federal Reserve was raising interest rates and every other sector of the market was collapsing. Tech stocks were down 40%. Real estate was crashing. Crypto had imploded. The market needed a new narrative, a new reason for valuations to stay inflated despite monetary tightening destroying everything else. And that's when artificial intelligence became the story. Suddenly, every company was an AI company. Every earnings call mentioned AI transformation. Every investor presentation showed AI revenue projections. It didn't matter if the technology was real or the business model made sense. The market just needed something, anything, to justify keeping asset prices elevated. So money flooded into AI stocks. Nvidia went from $150 billion market cap to over $3 trillion. Microsoft added $1 trillion in value on AI promises. Google, Amazon, Meta, they all saw massive valuation increases based entirely on projected AI revenue that hasn't actually materialized yet. And here's the critical part. That money didn't just inflate AI stock prices, it became the collateral for everything else. Banks lent against AI stock portfolios, pension funds allocated based on AI growth projections. Private equity valued companies using AI multiples. The entire financial system started using inflated AI valuations as the foundation for credit creation and risk assessment. But the revenue never came. Not at the scale promised, not even close. OpenAI is burning billions of dollars with no path to profitability. Most enterprise AI projects are failing to generate return on investment. The productivity gains everyone predicted haven't shown up in economic data. Companies are spending hundreds of billions on AI infrastructure and getting back tens of billions in revenue. And here's what makes it even worse. The infrastructure cost of AI is absolutely destroying these companies from the inside. Microsoft is losing an estimated $600,000 per day just running their AI services. Google's AI operations are bleeding similar amounts. These aren't small inefficiencies. These are catastrophic cost structures that make no economic sense. The electricity demand alone is staggering. A single ChatGPT query uses nearly 10 times the energy of a Google search. Multiply that by millions of queries per day, and you're talking about power consumption that rivals small countries. Data centers running AI models require constant cooling, massive server farms, and infrastructure maintenance that costs tens of millions monthly. But here's the insane part, they're giving it away. Microsoft offers AI features in Office for barely anything. Google integrates AI into search for free. OpenAI charges $20 a month for ChatGPT Plus when the actual cost per user is multiples of that. They're operating at massive losses, burning through hundreds of thousands of dollars daily, all to maintain the narrative that AI is the future. Why? Because the moment they price AI services at what they actually cost to run, the adoption disappears. Enterprise customers won't pay, retail users won't subscribe. The entire growth story collapses. So instead, they subsidize massive losses, report them as investment in future growth, and hope the market keeps believing the revenue will eventually materialize. It won't, because the fundamental economics don't work. The cost of providing AI services exceeds what customers will pay by such a wide margin that there's no path to profitability without either massive technological breakthroughs that reduce costs by 90% or pricing increases that kill adoption. Neither is happening. That's not a business model, that's a Ponzi scheme. And like every Ponzi scheme, it works perfectly until the moment it doesn't. The $600 billion drop last week wasn't profit-taking. It was the first wave of smart money recognizing the game is over. Because when you build an entire financial system on inflated valuations, and those valuations start cracking, you don't get a gentle correction, you get a cascade. Here's what most people don't understand about systemic bubbles. They're not just about one sector being overvalued, they're about that overvaluation becoming embedded in the credit system. When AI stocks were rising, banks accepted them as pristine collateral. Hedge funds leveraged them aggressively. Retail investors bought them in retirement accounts thinking they were safe. But collateral only works if the asset maintains its value. The moment AI stocks start falling sustainably, all that leveraged exposure becomes toxic. Margin calls trigger, forced selling begins. And because so much of the financial system used AI stocks as foundation assets, the selling spreads to everything else. This is exactly what happened in 2008 with housing. The problem wasn't just that house prices fell, the problem was that housing had become the collateral for the entire credit system. When housing collapsed, it took down the banks, the money markets, the commercial paper market, everything that depended on housing-backed assets maintaining value. We're watching the same pattern unfold with AI. Except this time the bubble is bigger, the leverage is higher, and the systemic risk is concentrated in the exact companies that everyone was told were too essential to fail. Now here's where it gets darker. The Federal Reserve knows this. They've known for months. That's why they've been quietly adjusting bank capital requirements. That's why repo market operations have been unusually active. That's why there have been emergency meetings that don't make headlines, but show up in Federal Reserve minutes, weeks later. They're preparing for a credit event, not hoping to prevent one. Preparing for one. Because at this scale, with this much leverage, with this much systemic exposure, there's no soft landing. There's only managing the crash. And the crash has already started. You're just watching it in slow motion because that's how these things unfold. First, the cracks appear in the highest flying stocks, then the selling spreads to related sectors. Then credit markets start freezing because nobody knows which institutions have toxic exposure. Then the banking system locks up. Then governments step in with bailouts that destroy currency value while trying to prevent total collapse. Every major bubble follows this sequence: 1929, 2000, 2008, and now 2025. The mechanics are identical, only the asset class changes, but this time there's a factor that didn't exist in previous crashes: algorithmic trading and passive investing. Over 60% of stock market volume is now automated. Index funds and ETFs own massive positions in AI stocks because those stocks dominate market cap weighted indices. When selling pressure hits, algorithms don't distinguish between good reasons and bad reasons to sell. They just execute based on price action and volatility. That means when the real cascade begins, it'll be faster and more violent than any previous crash. Not because the underlying problems are worse, though they are, but because the market structure itself is designed to amplify moves in both directions. The same passive flows that pushed AI stocks to absurd valuations will accelerate their collapse when the reversal fully takes hold. And we're already seeing the early signs. Trading volumes have spiked. Volatility indices are rising. Put option activity on AI stocks has exploded. These aren't signs of healthy profit-taking. These are signs of institutional positioning for a major downside move. Smart money isn't selling because they think valuations are slightly high. They're selling because they see the same pattern that preceded every major crash. Unsustainable valuations built on leverage and narrative rather than fundamentals. Retail investors still buying while insiders sell. Media defending the bubble even as it starts cracking. And most importantly, the bubble asset becoming systemically important to credit markets. That last factor is what makes this worse than previous bubbles. In 2000, when tech stocks crashed, it hurt portfolios but didn't destroy the credit system. In 2008, housing was systemically important, so the crash nearly brought down the entire financial system. This time, AI stocks are both the equity bubble and the foundation of credit market confidence. When they fall, both systems break simultaneously. Here's what that means in practical terms. When the AI bubble fully bursts, you won't just see stock portfolios decline, you'll see credit freezes because banks won't know which counterparties have AI stock exposure. You'll see money market funds break the buck because they hold commercial paper from companies leveraged to AI stocks. You'll see pension funds reveal massive underfunding because their return assumptions were based on AI growth that isn't happening. And when credit freezes and pensions break and banks start looking unstable, governments have only one response: print money. Lots of it, not because printing money solves the problem, but because allowing deflation and bank failures is politically impossible. So what you're really looking at isn't just a stock market crash. It's a currency crisis hiding behind a stock market crash. The choice will be deflationary collapse or inflationary bailout. And governments will choose inflation every single time. That means your real question isn't whether AI stocks will recover. It's whether the dollar will maintain purchasing power through the bailouts required to prevent total financial collapse. And history gives a very clear answer to that question. Every time a systemic bubble bursts and requires government intervention, currency loses value. Sometimes gradually, sometimes catastrophically, but always directionally the same. The bailout saves the system but destroys the money. In 1929, the dollar lost over 40% of its purchasing power in the decade following the crash. In 2008, the bailouts led to a decade of asset price inflation that made everything from housing to healthcare unaffordable for average people. This time, with debt levels triple what they were in 2008, and the bubble concentrated in systemically important companies, the currency impact will be worse. So if you're sitting in cash thinking you'll be safe when stocks crash, you're making the same mistake people made in every previous crisis. Cash protects you from asset price deflation, but exposes you completely to the currency debasement that follows the bailout. The institutions selling AI stocks right now aren't moving to cash. They're rotating into hard assets, gold, commodities, real estate in specific markets. Bitcoin, for those who understand the game being played, anything that can't be printed or devalued through monetary expansion. Because what's coming isn't a normal bear market where you hold cash and buy the dip. What's coming is a systemic reset where the winners are the people who positioned in scarce assets before the bailouts began, and the losers are the people who believed the narrative that AI stocks were safe and dollars were stable. The $600 billion drop is the warning. It's the crack in the dam. It's the moment where people who understand historical patterns recognize this is the same setup that preceded every major financial crisis. Excessive leverage. Systemically important bubble asset. Insiders selling. Retail still buying. Media defending the bubble. And central banks preparing emergency measures. You've seen this movie before. You know how it ends. The only question is whether you're positioned for the ending or still hoping the narrative changes. Here's the final piece almost nobody's connecting. The AI bubble isn't collapsing because the technology failed. It's collapsing because the financial system needed AI to justify valuations that were already indefensible. When interest rates were zero and money was free, you could justify any valuation with future growth projections. But when rates rose and money got expensive, those projections needed to materialize into actual revenue. They didn't. They won't. and now the system built on those projections is unwinding. That's not a technology problem, that's a monetary problem, and monetary problems don't resolve through innovation or productivity. They resolve through defaults, bailouts, and currency resets. Always have, always will. The 1929 crash led to a complete restructuring of the financial system and a devaluation of the dollar against gold. The 2000 crash led to a decade of monetary expansion and the housing bubble. The 2008 crash led to quantitative easing and a decade of everything bubble. And this crash will lead to something even more extreme because the debt levels and systemic leverage are higher than they've ever been in history. You're not watching a stock market correction. You're watching the beginning of a monetary reset. And the people who understand that distinction are the ones who will not just survive what's coming, but profit from it. But the real shock hits when you realize the AI bubble was never truly about artificial intelligence. It was about propping up the financial system just long enough to shift into the next phase of monetary control. And what that next phase looks like? Almost no one is ready for it. I break it all down in the next video. It's right here on the screen. Hope to see you there.